So, is the global economy about to crash? Well, the answer might lie in a part of the financial world you've probably never even heard of. It's this hidden market that has just exploded to over $2 trillion, and right now is showing some really serious signs of stress. So, the big question we're asking is, could this be what triggers the next big crisis? Our story kicks off with a pretty quiet announcement from a name you definitely know, BlackRock. They're the biggest asset manager on the planet. And while everyone was distracted by other headlines, they did something that should have been a massive red flag for the entire system. You see, they put a block on investor withdrawals from one of their major funds. And this isn't some tiny, obscure fund we're talking about. This thing holds $26 billion. Now, that's not just a small problem. That's the kind of tremor you feel right before the earthquake hits. So what's really going on here? Well, to get it, you have to think of this as something like a modern-day bank run. But this one isn't happening at your local bank branch, it's happening in the shadows of the financial system. When a huge fund like this slams the brakes on withdrawals, it tells us three things at once. First, it's a sign, right? It means the really smart, sophisticated investors are all trying to get their money out at the same time. Second, it's a symptom that the people running the fund think things are about to get a lot worse. But here's the real kicker. This could be the cause of a massive chain reaction because thousands of businesses, real everyday companies rely on this exact kind of money to keep their doors open. And that brings us right to the center of this whole mess, this massive, kind of murky market called private credit. This is the shadow banking system that's completely changed the game for how businesses get their funding. It's actually pretty simple. If a company gets a loan, but it's not from a regular bank like Chase or Bank of America, that's private credit. It's all the lending that happens outside of the normal, heavily regulated banking world. So you might be asking, why did this thing get so huge? Well, after the 2008 financial crisis, a bunch of new rules came in that made it really tough for big banks to make custom or slightly riskier loans. Think of it like this. The big banks became like McDonald's. They only wanted to sell standardized stuff, like cheeseburgers and fries, or in their case, mortgages and credit cards. They totally stopped taking special orders from all these medium-sized companies. And you can see right here why private credit stepped in to fill that gap. Where banks were slow and rigid, private credit was fast and flexible. For a huge chunk of the economy, it basically became the only place they could go to get the money they needed to grow. But of course, there's a catch. This brave new world of fast, easy money has a really dark side. The whole system is built on a mind-boggling amount of borrowing. It's just a cycle of debt feeding on more debt. Okay, so here's the playbook, especially for private equity firms, who are the #1 customers here. First, you raise some cash from investors. Then, you use that cash to borrow a ton more money. With that big pile of borrowed cash, you buy a company. Then, and this is the crazy part, you force that company you just bought to take on a bunch of new debt to pay you back. That frees up your original cash so you can go do the whole thing all over again. It's a house of cards built on borrowing. And that really is the whole point. The entire game is designed to pile debt on top of debt on top of debt. Why? To squeeze out every last drop of potential return. It looks great on paper when things are going well, but it also makes the whole system incredibly fragile. If just one link in that chain breaks, the whole thing could come crashing down. Now, for the last decade or so, this all worked just fine, mainly because borrowing money was basically free. But a system built on this much debt is super vulnerable to one thing: interest rates going up. And right now, the cost of all that debt is squeezing this market to its breaking point. The entire equation has flipped. Just a couple years ago, the return you'd get on a super safe U.S. Treasury bond was almost zero. Today, it's around 5%. So suddenly, investors are asking themselves, why would I take a huge risk on some weird private loan for a 9% return when I can get a guaranteed 5% from the government risk-free? The whole incentive to pour money into this shadow market is just evaporating. And for the companies that actually took out these loans, the effect is absolutely brutal. See, most of these loans have floating interest rates, which means as the Fed raises rates, their payments go up too. A company that had a totally manageable $4 million interest payment could suddenly be looking at an $8 million payment on the exact same loan. That's the kind of thing that leads to bankruptcy, fast. So with all this pressure building up, are we actually seeing the cracks start to form? Well, if you look at the data, the answer is a pretty clear yes. The ratings agency Fitch just came out and said that defaults in this market have hit the highest levels ever recorded, But here's the truly scary part. Fitch only started tracking this stuff in the middle of 2022. We are flying completely blind here, in totally uncharted territory, and the only trend we can see is pointing straight down. Now, you might be thinking, okay, but this is all happening in the shadows, so it won't affect the real banking system, right? Wrong. The Fed was already worried back in 2022 when banks had about $95 billion of exposure. But a new analysis from Moody's estimates that number has now more than tripled to around $300 billion. This is what they call contagion risk, the very real danger that this problem could spread like a virus from the shadows right into the mainstream banks we all rely on. And this is where it starts to affect everyone. It kicks off this vicious cycle in the real economy. Companies loaded with debt start to struggle, so they lay people off. Now you have more people unemployed, so they spend less money. That means less income for other businesses, which forces them to lay people off. It's a downward spiral that can pick up speed really, really fast. So all of this brings us to the ultimate question. How does this new, looming risk stack up against what we saw back in 2008? Is this shadow market also too big to fail? Well, let's put it in perspective. Remember the 2008 crisis? The whole thing was triggered by subprime mortgages. The total value of all those bad home loans was about $1.3 trillion. The private credit market today? It's estimated to be over $2 trillion. Some people think it's even closer to $3 trillion. Just by the sheer size of it, the potential problem we're looking at now is way, way bigger than what broke the world back then. And a crisis today would feel totally different. Back in 2008, the problem was bad loans on houses. This time, it's bad loans on actual operating businesses. The fallout wouldn't just be foreclosures, it would be mass bankruptcies, huge layoffs, and cuts to services we all use. Plus, unlike in 2008, the government is already struggling with high debt and high inflation, which means it has way less firepower to come in and try to save the day. So let's boil it all down. What we have is a hidden multi-trillion-dollar market that's flashing all the warning signs of a bank run. It's built on a tower of debt. It's starting to crack under the pressure of higher interest rates, and the risk that it could infect the entire global economy is very, very real. And that leaves us with one last really unsettling question. In 2008, the government stepped in and bailed out the big banks. But if this shadow system collapses, who, if anyone, is going to bail out the shadows?